Okay, so let's start. We want to start a new topic. We want to start a new topic now. And our new topic is called group cash flow statement. Some questions will call it statement of cash flow or group cash flow statement. Let me introduce it. Now, this topic is not a new topic to you. You must have done cash flow before. Obvious, you must have done it in your financial accounting. That is how you started. In your financial accounting of what used to be section 1, you had to do a cash flow for a normal company. After that, you went to financial reporting. That was what used to be in section 3 or now intermediate. You also learned cash flow statement. So now we want to develop it. And look at the aspects that affect group as a group. How do you prepare a cash flow for the group? Now listen, before we do a cash flow or the aspects that affect the group, I want to remind you the general overview of how you used to prepare a cash flow statement. I want to remind you in an overview first how you used to prepare a cash flow statement. Of course, I know you know that every time the examiner used to tell you to prepare cash flow statement, the cash flows had to be classified. The cash flows had to be classified into 3 categories. You remember, there used to be cash flows from operating activities. There used to be cash flow from investing activities, and also cash flows from financing activities. Good. Now, before I go into the details, now let me explain. Before I go into the details, now listen. For the new students who are here, I want to explain the modality of a live class because sometimes it may happen to you. Listen, I'm talking to the new student because again, today is a free class. Now listen, in case you are disconnected, listen, in case you are disconnected because of your Wi-Fi strength being weak, how can you come back to class? Suppose you click on the video that was disconnected and it doesn't bring you back to class. If that does not happen, then there are 2 other ways in which you can come back to class. One is you can refresh your page. Normally, the page from which you are watching the video from, either on the top left or on the top right of that page, there is always a refresh button, which looks something like this. If your gadget has it, then if you are disconnected, then you can refresh the page. That will bring you back to class. If that does not happen, then you can go back to where you got the link from and click the link again. And you click the link again. So sometimes you may be disconnected because of your Wi-Fi strength being weak once in a while, especially when you're watching a live class like this one. I have said, if you click on the disconnected video and it doesn't take you back to class, please refresh your page using the refresh button. You click it. If your gadget has a refresh button, it's always on the top left or top right of your page. If the gadget doesn't have it, then you can go back to the group or the link where you received. You go back to where you received the link and click on the link again, meaning it's like you are joining the class. Good. Another appeal, I will appeal to you, everyone now. I am appealing. If you have not subscribed to my YouTube channel, If you have not subscribed to my YouTube channel, please subscribe by hitting that subscription button down there. Hit that subscription button and also hit that notification bell. This will help you to be receiving notification anytime we post a video in our YouTube channel. So for those who have not subscribed, even as I'm teaching now, please click on that subscription button and you will subscribe to our YouTube channel. So even as we are doing now, you can still subscribe. Even as I'm teaching now, you can still subscribe. So please subscribe by hitting that subscription button. Good. So let's now continue. I have said that I want to remind you how you used to prepare a cash flow statement for an individual company. I've told you that you had to classify, you remember, you had to classify your cash flows into 3 categories. Category number 1 was the cash flows from, you had to identify cash flows from operating activities. You had to identify the cash flows from operating activities. Whichever they were, of course, you remember, some of them were positive, some of them were negatives, whatever they are. So you have to identify those cash flows from operating activities, some positive, some negative, whatever they are. Good. Once you identify those cash flows from operating activities, listen, you remember you had to get the net of all of them. And whatever the net amount you got, that amount, you had to push it to the extreme. You had to push it to the extreme. That amount could either be a positive amount or it could have been a negative amount. For now, let us assume that you got a positive amount. If it's a positive amount, you used to call it net cash inflow from operating activities. If it was a positive amount, you used to call it net cash inflow from operating activities. If it was a negative, you used to call it net cash outflow from operating activities. So for now, we are assuming you have identified. Of course, we shall come back in details. Then you had to go to the second category, and that second category was what you used to call cash flows from investing activities. Cash flows from investing activities. Again, you had to identify the cash flows from investing activities. Again, some positive, some negative. Whatever figure you got, that net again of all of them, again, you had to push it to the extreme, whatever it is. For now, let me assume that the negatives were more than the positive, so you ended up getting a net negative. That net negative, you had to call it net cash outflow. Net cash outflow from investing activities. Net cash outflow from investing activities. Okay? That was the second category. That was the second category. After you're through with the second category, you had to go to the third category, and that's what you used to call cash flows from financing activities. Cash flows from financing activities. Again, you had to identify from your financing activities which cash flows do you have, which cash flows do you have. Some again positive, some again negative. For now, let me assume that you got a net of all of them as a positive. If it's a positive, you pushed it to the extreme. Assuming it's a positive, you had to call it net cash inflow You had to call it net cash inflow from financing activities. Net cash inflow from financing activities. Listen, so I'm assuming now you have identified all the cash flows from the three categories: the operating, the investing, and the financing. Listen, once you identified those three categories, you had to get the net. You had to get the net of the three totals. Net of the three. That means whatever was the operating amount, whatever was the investing amount, and whatever was the financing, get the net of those three. That net again would either be a positive or it could be a negative. If it's a positive, you remember you used to call it increase in cash and cash equivalent. Increase in cash and cash equivalent. Of course, if it was a negative, you remember you used to call it decrease in cash and cash equivalent. If it's a negative, we are assuming it's a positive, so we call it increase in cash and cash equivalent. Then you remember you had to add what you called opening cash and cash equivalent. Opening cash and cash equivalent. Whatever it is, listen, you remember, anytime the examiner used to give you a question on cash flow, he would always give you a balance sheet for last year and a balance sheet for this year. So from the balance sheet last year, whatever was the cash and cash equivalent by end of last year, that is what automatically became the opening cash and cash equivalent by the beginning of this year. So whatever it was, you had to bring it down. Then, once you got that and you added the opening cash and cash equivalent, you had to get the net again, the total there. That total, we called it, or you remember you are calling it closing cash and cash equivalent. Closing cash and cash equivalent. Closing cash and cash equivalent. That is the closing by the end of the year. Whatever is the closing cash and cash equivalent, you remember it had to be the same. It had to be the same as the balance of the cash in the balance sheet by end of this year. It had to be the same. That figure you're getting down there should always be the same as the amount of the cash and cash equivalent as at the balance sheet of this year. Good. Listen, don't try it yet. We are just going through in an overview first. So this is the format in general of how you used to prepare a cash flow statement. You had to identify the cash flows from operating, identify the cash flows from investing, and identify the cash flows from financing. Good. Now we want to go back to each of these three categories. We want to go back to each of these three categories and discuss now in details how are you determining the cash flows from operating, how do you identify the cash flows from investing and financing. So let me start with the cash flows from operating activities. How do you identify the cash flows from operating activities? Now, listen. Before we discuss how to prepare or to determine the cash flow from operating, I also do hope you remember that when you did this topic, you remember there were two methods of preparing a cash flow statement. There were two methods of preparing a cash flow statement. One method is what is called the indirect method, and the other one is what used to be called the direct method. The direct method. Now, of the two methods, you remember the most common one was the indirect method. The indirect method. So we want to go through the discussion by assuming, suppose we are using the indirect method. Now listen. The difference between the direct method and the indirect method, the difference was only in the section of the operating. Otherwise, how you present the investing And how you present the financing does not change whichever method you are using to prepare your cash flow. Whether you are using the direct method or the indirect method, the two sections called investing and financing does not change. The only difference comes in how you present your operating good. So let me remind you again. Don't write again. I just want to remind you. Let me remind you how you used to determine the cash flows from operating activities using the indirect method. But before we do that, we need to know what are the cash flows from operating activities. What are operating activities? Which kind of activities are these? Listen, operating activities, we say they are those transactions and events, that are used in the determination of profit, those transactions and events that are used in the determination of profit, those transactions are the ones we call operating activity. Any transaction that was used by the company to determine the profit of the company, that transaction is what we classify as an operating activity. In other words, for example, this being your income statement or profit and loss, let us assume that you prepared your P&L account in a T format and you got a profit, let's call it profit before tax, of 20 million. So effectively, listen to this now, you know, in the P&L account, we normally debit P&L account with the expenditures. Those are like outflows. We credit P&L account with the incomes and gains. That's like inflow. So in principle, therefore, listen, in principle, therefore, we can conclude that this 20 million we are getting as the profit before tax, effectively, therefore, listen, effectively, therefore, should be the net cash inflow from operating activity. Effectively, that 20 million should be the cash flow from operating activities. Why? Because you have compared the inflows on the credit with the outflows on the debit, and you have got that net of 20. So effectively, we are saying whatever you got as your profit before tax, that profit before tax should always represent, or should be, in ideal situation, represent your net cash flow from operating activities. So we normally start, or you remember, we were starting with the profit before tax. But then, listen to this now. Is it true that that 20 million is the actual net cash inflow from operating? The answer is no. Why? Because not everything, listen to this now, not everything that normally goes to the income statement, either as an expenditure or to the income statement as an income, not everything goes to the P&L account, which is in cash form. No, not everything is purely in cash. But what are we looking for? We are looking for the net cash inflow from operating activities. Listen, if everything in the P&L account was by cash, either on the debit or on the credit, then you could conclude that the 20 million is the net cash inflow. If everything in the P&L account was by cash, then you could conclude that the 20 million is the net cash inflow. But because not everything that went to the P&L account is a transaction that took place in cash form, no. Then, listen, then to determine the cash flow from operating activities, we normally then use that profit before tax, listen, and then adjust it and adjust it with the few items that went to the P&L account which no cash was involved at all. Either you could have debited the income statement, or that is P&L, or you could have credited P&L account with something, yet it is not a cash item. So that we adjust this 20 and ask ourselves, we adjust it with those items, so that we ask ourselves, if everything in the P&L account was by cash, what would have been the true profit before tax? Don't forget, we are looking for cash flows from operating activities. And I've told you, cash flows from operating activities are those transactions and events. Those transactions and events that are used in the determination of profit, those are the ones we classify as operating activities. Good. So let's now ask ourselves, what are some of the transactions that we could have either debited the P&L account with or credited P&L account with, yet no cash was involved? I know you know some. Like, for example, one of them could be depreciation charge. When you depreciate your motor vehicle or furniture or building, that is not something you paid cash with. No. Normally, that is just a bookkeeping entry. So assuming you debited P&L account with a depreciation charge of 2 million, that 2 million is what you normally call a non-cash item. So we want to ask ourselves, assuming this 2 million was not in the P&L account, what would have been the true profit? What would have been the true profit before tax? So we ask ourselves this: what effect from the cash point of view? I am not saying the profit of 20 is wrong. The profit of 20 is right. From the accounting point of view, that profit is right. But when we look at the income statement from the cash point of view, that 20 is wrong. So we are asking ourselves, if this 2 million was not in the income statement, would my profit be more than 20, or would our profit be less than 20? It is obvious. Listen, by you including it, that 2 million depreciation, by you including it in the P&L account, listen, it means you overcasted expenses. Listen, you overcasted expenses from the cash point of view. You overcasted expenses. Listen, you know, when expenses are overcasted, automatically profit is undercasted. And so you remember, once you got that profit before tax, you had to adjust it with items like depreciation. You had to come and add depreciation charge, whatever it is. Then you go through the question and find out what are the other non-cash items. Other non-cash items that could have gone to the income statement, yet no payment in cash was done, or no receipt in cash was done. That's what we are trying to identify. Good. So I can give you one or two more so that you also help me to identify some more. Another transaction that you could have taken to the P&L account, which no cash was involved, could be things like provision for bad debts. When you anticipate, listen, when you anticipate that some of your debtors are likely not to pay you, you are normally required to provide for bad debts. When you anticipate that some of the debtors are likely not to pay you, you are required to provide for bad debts. So assuming you anticipated that some debtors are likely not to pay you, so you provided for bad debts of maybe 1 million or whatever it is, that's not something you paid cash on. No, it's just a bookkeeping entry. So we are asking ourselves, what effect did it have on the profit from the cash point of view? Again, It's an expense. It means, again, our expenses were overcasted from the cash point of view. So by expenses being overcasted, profit will be obviously undercasted. So we come and add any provision for bad debts. Provision for bad debts, whatever it is. Let me give you another one. Another one could be bad debts themselves. When one of the debtors was declared bankrupt. So you as a company, you wrote him off as a bad debt. When you wrote him off as a bad debt, you must have debited P&L account with the amount of the bad debts. Did you actually pay that amount? No. It's just a bookkeeping entry. You had to write him off, that debtor, as a bad debtor. So you recognized a loss. There is nothing you paid for that amount. No. So again, that is another non-cash item. That's another non-cash item. Again, it made your expenses more than they should be from the cash point of view. So you come and again add that amount we are calling bad debts. Whatever it is, you add it. Now, for the sake of it, now I want to ask you a few more. Remind me a few more of the non-cash expenses or non-cash items. Think of any transaction. Listen, think of any transaction that could have gone to the P&L account and yet you never paid for it in cash. Think of an item that went to the P&L account and yet no cash was involved at all. I'm not asking you to remember from the cash flow point of view. No, even from the normal accounting. Tell me of something that normally goes to the income statement, which normally no cash is involved. So somebody lists a few of them. List a few. Loss on disposal, that's true. Gain on loss on disposal, that's the same. Good. Another one. Let me first explain that one as somebody's listing another one. Listen, let me explain that one. Listen, you had a motor vehicle which had a net book value of 10 million. You had a motor vehicle which had a net book value of 10 million. You sold it for cash of 8 million. In your books as a company, it had a value of 10, but you sold it for 8. So you received cash of 8. But in your P&L account, you must have taken a loss of 2 million shillings in the P&L account as a loss on disposal. Did you pay that 2 million? No, but you recognized it as a loss. So we are saying you debited P&L account with that one. So automatically, again, from the cash point of view, your expenses are overcasted. So you come and add, because expenses being overcasted, profit is undercasted. So you add that loss on disposal. Good. Listen, in case, assuming now, listen to this now, what if you sold that machine not for 8 million now, but you sold it for 12 million? It had a book value of 10, you sold it for 12. So you must have taken to your P&L account a gain of 2 million. Took to the P&L account a gain of 2 million. Did you receive the 2 million? No. What you received is 12. But you took to the P&L account as a gain. Yet you never received that 2 million. So it's again another non-cash item. So which means, again, it made your profit. This time, you added it. You credited P&L account. So it made your profit more than it should be. So if it's a gain on disposal, you have to come and subtract. Gain on disposal, you had to minus. Why? Because it made your profit more than it should be. Good. Somebody else is giving us another one down there. Good. is giving us another one called impairment. That's true. Impairment of goodwill. That's true. When you impair your goodwill, it's like you are depreciating your goodwill. And therefore, any goodwill impairment, again, will be something you debited P&L account with, yet no cash was involved. So we come and see a goodwill impairment. That is also something you add. Somebody has given us another one, and that is amortization. Good. Amortization is the same as depreciation, except that you are amortizing your intangible assets, copyrights, trademarks, and so on. When you amortize your intangible assets, that amortization is not something you paid for, and therefore we are saying it went to the P&L account, yet you never paid for it. It made the expenses to be overcasted from the cash point of view. So any amortization, you come and you add. Good. Give me some more. Give me some more. You have given me the loss on disposal, that's true. Gain on disposal, that's true. You have given me impairment of goodwill. No. Lillian, no. Not accrued expenses. We shall talk about that later. Not as an uncash item. No, that one we shall talk about it later. We are looking for something you debited P&L account with, or you credited P&L account with, which no cash was involved, as an uncash item. Yes? There is something you have not given me. There is something you have not given me. There is something you have not given me. Listen. Listen carefully now. Everyone are good. Are good. Thank you. Thank you, Esther. Thank you, Esther. I was almost thinking that nobody will give me that amount or that item. Listen carefully now. That's called finance cost. It's also called in some questions interest charge. And I want to take you through, listen carefully now, I want to take you through how interest charge or finance cost is an uncash item. Listen, some people forget it to use. I was waiting. That's why people gave me the most common ones. Amortization, impairment, depreciation, and so on. I was waiting and I was hoping that nobody will not give us this figure called finance cost. But let me explain it. Now, for me to explain it, I want to take you back to your financial accounting of section 1. And especially when you are doing the topic called company accounts. In that topic, you used to be given a trial balance, for example, of this nature. In that trial balance, you used to have something like 10% debentures. Let us assume 500,000. In that same trial balance, you used to have something like interest on debenture amounting to interest on debenture. Let me assume 40,000. Then after you are given a trial balance, the examiner used to tell you, prepare A, income statement, B, balance sheet. So I want you to tell me from this illustration, what do you think your company will charge as interest in the P&L account? How much? From this illustration, how much will your company charge as interest in the P&L account? When this company will be preparing their income statement, they will charge how much as interest? Chart there and give me the answer. What do you think the company will charge as interest? How much? From this illustration, when the company is preparing their income statement, they will charge how much as interest? Yes. They will charge how much as interest? I'm waiting. This is not something new. No. You must have done it even when you are doing financial reporting in in the topic of published accounts. Somebody is saying 10,000, somebody else is saying 50,000. Somebody else. I want to hear one more opinion. Another one. Oh, Daniel. Daniel has changed and is saying 50. Sorry, 50. Okay. I'm not saying they are right. I'm not saying they are wrong. But I want us to get one more opinion. Those are two more. Esther says 50. Sawa. Good. Now listen. It's true. When a company is preparing their income statement or their profit and loss, you know that the company in accounting, we normally follow what we call accrual concept. Accrual concept states what? Accrual concept states that costs should be recognized when they are incurred, but not when money is paid. Costs should be recognized when they are incurred, but not when money is paid. Listen. So when this company is preparing their income statement, they will see they have a 10% debenture whose value is 500,000. So every year, this company knows that they should pay interest. They should pay interest of 10% of the value of the debenture. That is the charge. So when the company is preparing their income statement, listen, they don't bother whether they have paid interest or not. Listen, when they are doing the income statement, not balance sheet, income statement, the company will not bother to know whether they have paid or not. They should recognize costs when it is incurred, but not when money is paid. So this year, as a company, you have incurred a cost of how much? 10% of 500, that is 50. It is when you will be preparing the balance sheet of this company that you will ask yourself, as a company, do we owe our debenture holders anything? From the trial balance, it's obvious I was supposed to pay them 50. But according to the trial balance, I've only paid them how much? 40. That's what we have paid. So it automatically means that when you are doing the balance sheet of this company, among the current liabilities, there you will have debenture interest owing of how much? 10,000. You will have debenture interest owing of 10,000. Now listen, my concern is this now, that in the income statement, there is another 50. In the income statement of this company, there is a 50 that we actually never paid for. This interest of 50, is it something we paid? No. It is just a bookkeeping entry. You took 10% of the debentures and you got 50,000. Did you pay 50,000? No. So listen carefully now. So that 50, being the charge for the year, which we are calling finance cost, will also be among the non-cash items. That is finance cost. That 50. Whatever it is, let's just use X. Now, for now, and I want you to listen carefully. For now, let me assume those are the only non-cash items. Okay? I am assuming those are the only non-cash items. The other point I want to mention before we leave this section is this. And I'm hoping you will not forget it. Listen. In any question you ever did, whether in section 1 financial accounting or in financial reporting, within these non-cash items, listen, there are two things among the non-cash items in any question that never used to miss. In any question, they would never miss. One is depreciation. That is something you should always know, that if I'm given a question on cash flow, depreciation will be there among the non-cash item. Two, finance cost. Those two will always be there in any question you will do, even at this level, and even the questions you have done before. The others, like provision for bad debts, loss on disposal, gain on disposal, impairment, amortization, those ones normally depend with the question. But for depreciation, I'm hoping you're following, and finance cost, those two are always something you should know. They are there in any question. Listen, when it comes to finance cost, it is something you will be given. Why? You know. In any question you have done in cash flow before, the examiner normally gives you the income statement for that year and two balance sheets, one for last year and one for this year. And therefore, from the P&L account this year, whatever is the finance cost, you can pick it from that income statement. When it comes to depreciation charge, there are some questions that will tell you the charge for the year was this much. In some questions, you have to calculate it. Either way, it will be there, but you either are given or you calculate. Now listen. So it means when I'm required to prepare cash flow statement, three ticks I know I should not miss. One, profit before tax. Why should you lose that mark? Because it's something you just go to the income statement and pick it. Why should you lose the amount for depreciation if it's given, unless they are calculating it and you're not sure how to calculate it? Finance cost, it's obvious, you pick it from the income statement. Then I am now saying, look for the other non-cash items, which I have given examples like provision for bad debts, loss on disposal, gain on disposal, impairment loss, amortization. Listen, for now, let me assume those are the only non-cash items. Once you got them, you remember you had to get the totals. Listen, that total, you used to call it cash flow. You used to call it cash flow before working capital changes. You used to call it cash flow before working capital changes. Then you now had to go to the working capital items now. You had to go to the working capital items. Of course, you know working capital items include items of current assets and current liabilities. Those are the ones that form working capital. I've told you the question will always give you one balance sheet last year and another one this year. So you go to the balance sheet among the current assets and you find there was maybe an increase in stocks. Of course, you know, for stocks to go up, what must have happened? For stocks to go up, you must have purchased. That's an outflow. Maybe you also go to the debtors and you find that there was decrease in debtors. Of course, for debtors to go down, what must have happened? For debtors to go down, last year debtors was 8 million, this year debtors are 2 million. For debtors to go down, we must have received from debtors. We must have received from debtors. That is obviously an inflow. Listen. Then, listen carefully. Among the working capital items, after stocks and debtors, there is always cash and bank. Do you analyze cash and bank here and say increase in cash and decrease in cash? Listen, no. Why? I told you, down there, I think I've rubbed it, down there, you always have a place for cash and bank balance, where I told you, you add opening cash and cash equivalent. So that's where we shall be putting the figure for cash. So you don't use it here. It's true, it's a working capital item, but it has its own place when it comes to cash flow. Good. Now listen. So those are the only current assets. You go to current liabilities. Among them, let me assume we have creditors. Last year, creditors were 10 million. This year, creditors are 5 million. Let us assume now that there was a decrease in creditors. For creditors to go down, what is it that must have happened? It is obvious for creditors to go down, as a company, you must have paid them. That is an outflow. Good. So for now, listen, for now let me assume that those are the only working capital items. You take that total, minus the negative, add the positive, minus the negative, get the net. Once you got that net, listen to this now, once you got that net, you had to come and now say here, tax paid. Whatever it is that you paid this year for taxes, which you always have to calculate, we shall do that later. But once you minus the tax paid, get the net. Listen, I now told you that the overall amount, you push it to the extreme. That is the net now from the operating activities. I told you it could be a positive or it could be a negative. For now, let me assume it's a positive, sorry. And I call it net cash inflow. From operating activities. Net cash inflow from operating activities. Good. So don't write. I'll put down the summary notes again. Don't write. We shall put down, just listen as we are going through, because I'll be asking you a few questions. Good. So don't write. We shall put down the format properly. So I'm through with the first category of the cash flows, and that is cash flows from operating activities. Now you go to the second category, and that's what we were calling cash flows from investing activities. Cash flows from investing activities. Before we identify them, you need to know what are these cash flows from investing activities. You remember from your previous accounting knowledge of cash flow, investing activities, listen, are those transactions and events that affect any fixed asset. Any transaction that affects a fixed asset, or what you can call a non-current asset, that is an investing activity. Among your fixed assets, were there changes? Yes. Those changes that took place and affect the fixed assets are what we classify as investing activities. For example, maybe there was a purchase of a fixed asset, like motor vehicle, furniture, and so on. That is obvious. It's an outflow. Maybe as a company, you sold furniture, maybe sell a fixed asset. When you sold a fixed asset, that money came in. That's an inflow. Good. Now listen carefully. Among the balance sheet items, listen, which is among the fixed assets in the balance sheet, or what you can call non-current asset, you may have land, you may have motor vehicle, you may have buildings, you may also have investments. Your company could have what we call long-term investments. Long-term investments. Maybe the investments last year were 5 million, according to the balance sheet of the year 2020. Maybe in the current year 2021, your investments are 8 million. What could have happened? It means you must have bought some more investments. Remember, they are among the fixed assets. Your investments are among the fixed assets. So you come and say here, purchase of investments. That's an outflow. Listen carefully. This is the point I wanted to bring in. Listen, these investments that you have as a company, maybe you bought some shares from Safaricom, BAT, whatever it is, and these investments gave you, as a company, they gave you an investment income, maybe in form of dividend. You received some dividends from your investments. Listen, any income you are receiving from your investments, that income is always classified as an investing activity. I have just told you, investing activities are those transactions and events that affect any fixed asset. So you have investments which go with investment income. So whatever we shall be given as investment income in that question, that investment income, don't take it as an operating activity. No. Any investment income which goes with the fixed asset called investments, that also becomes an investing activity. That's important to remember. We shall put down the format, don't forget. But I'm trying to say that some students forget to bring in investment income as part of the investing activities. Good. For now, listen, I want to assume for now that those are the only investing activities for now. I want to assume those are the only investing activities. Again, get the net of all of them. And whatever is the net, push it to the extreme. I told you it could be a negative or it could be a positive. For now, let us assume the negatives were more than the positive. If the negatives were more than the positive, then that is what you now call net cash outflow from investing activities. Net cash outflow from investing activities. Otherwise, if it's a positive, I would have called it net cash inflow from investing activities. Good. So I'm through with the second categories of the cash flows. Now I go to the third category. And that is the financing activities. So we come and now quote the cash flows from financing activities. Cash flows from financing activities. Again, you need to ask yourself, what are financing activities? Financing activities are those transactions and events that affect the finances of the company. Any transaction that affects the finances of the company, that transaction is what we call financing activities. For example, your company could have issued some more shares. Share capital is part of financing. You come and say your issue of shares. Of course, money came in. Maybe your company issued some debentures. Last year's debentures were 5 million. This year debentures are 8. So we must have issued some more debentures. Issue of debentures. Whatever it is, that's an inflow. Listen, maybe your company had a long-term loan. The loan last year was 10 million. This year the loan is 2 million. For the loan to go down, you must have repaid. You come and say a loan repayment. That's an outflow, of course. Now listen, let me assume for now that those are the major financing items. Listen, normally, to these financiers, you normally pay them their returns. To these financiers, we normally pay them their returns. And one form of payment we do to the financier called shareholder is the dividend. We normally pay them their dividend. I told you, it is financing activities are those transactions that affect finances. Anything affecting the finances will go to become financing. So when you pay dividends to the debenture or to the shareholders, Dividends paid, we shall also be classifying it as part of financing activity because you are paying to the financiers. Good. What about to the loan providers, to the debenture holders? What do you normally pay them as their return? You borrowed by financing through debentures or loan. You must pay them their return. What is it? You must have paid them interest. You come and say your interest paid, whatever it is. Now, even before I leave this point, listen. When I was talking about debenture interest, you remember I did an illustration and I told you among the income statement, you charged how much? 50. That 50, I told you, will be the non-cash item here. You remember? That 50. Then we saw from the same trial balance, the company had only paid how much? 40. Listen, it is not 40 now that you as a company, you will bring it down here as part of financing. That 40, not the 50. 50 is what you charged in the P&L account. But what is it that you paid? 40. So that's important to remember that among the non-cash items up there, there is not 50 or whatever the question will give you. Then down here, among the financing activities, it is what you actually paid for interest. So in our illustration, we paid 40. Good. So let me assume those are the only financing items. Get the net of all of them. Again, once you get whatever you get, push it to the extreme, whatever it is. So for now, again, I want to assume that we have a positive amount. If it's positive, we call it net cash inflow. We call it net cash inflow from financing activities, whatever it is. Then I told you, now that you have identified the cash flows from the three categories, get the totals of those three categories. Get the totals of those three categories. What? Operating figure, investing figure, whatever it is, and financing. Get the net of the three. Whatever you get, let us assume it's a positive. The net of the three is a positive. I told you, if it's a positive, you call it increase in cash and cash equivalent. Increase in cash and cash equivalent. Then I told you, now you come and add the opening cash and cash equivalent. Whatever is the closing cash last year, automatically it became the opening this year. Whatever you get down there now, that becomes the closing cash and cash equivalent. That becomes the closing cash and cash equivalent. Good. So this is the general format that we shall be using for preparing our cash flow statement. Now, before we go back and discuss the details of some more items in this cash flow, let's put down the format now, properly now. So let's put down the format properly now. So the topic, Andika, the topic is group cash flow statement. Group cash flow statement. Group cash flow statement. Then we come and put down the format now. We want to put it down slowly so that it becomes part of your notes. So finish. We want to put down the format. Good. So let's start. We have said cash flow from operating activities. The most common method I told you is the direct method, the indirect method. So I come and start here with profit before tax. Whatever the question will give you from the P&L account, we are now putting down the format. Then from there, I told you, you come and add depreciation charge. whatever it is, you add. Then I told you you add finance cost. Those two I told you, you should always remember, they will never miss in any question. They will never miss in any question. Good. After those two, now look for the others, depending on the question. Let us assume we have provision, bad debts. Provision for bad debts, whatever it is. Let's assume we have bad debts themselves. Bad debts, whatever it is. Then I said, if there is any loss on disposal, we add. Told you, if there's a gain on disposal, you minus. Gain on disposal, you minus. Okay. Then I told you, come and add impairment loss. Whatever is the impairment loss on goodwill, you add. I told you add amortization and any other. And any other. Good. So assuming that's all, get the net now. Whatever it is, I told you, that's what you now call cash flow before working capital changes. Cash flow before working capital changes now. Finish. We go to the next part. Good. After you have done that, we come and bring in the working capital items. Let me assume increase in stocks. Stocks went up. You must have acquired. That's an outflow. Let me assume decrease in debtors. Debtors to go down. We must have received. That's decrease in debtors. I told you, for cash and bank, they have their own space. So we don't bring them in here. No. Then you come and now say, decrease in creditors. For creditors to go down, you must have paid. Let me assume those are the only ones. The net. That net, we said, you now minus tax paid. Whatever it is that you paid for taxes this year, get the net, push it to the extreme. Get the net, push it to the extreme. Get that net and you push it to the extreme now. And that net, if it's a positive, I've told you, it's called net cash inflow. If it's a negative, it's called net cash outflow. For now, I want to assume it's a positive. I call it net cash inflow from operating activities. Net cash inflow from operating activities. Good. After that, I go to the second category now. We go to the second category now, and that's what we are calling cash flow from investing activities. Cash flows from investing activities. We have already discussed them. We are just putting down the format now, officially. Good. So let's do, we have said, purchase of fixed assets. Whatever it is, that's an outflow. You to purchase a fixed asset, you must have paid. Then you can come and see a sale of fixed assets. Sale of fixed assets. That's an inflow. Maybe motor vehicle, you sold furniture, and so on. Then you come and see a purchase of investments. That's an outflow. Purchase of investments. Then I've just told you a short while ago, if those investments give you them dividend, that investment income is also an investing activity. Investment income, that's an inflow. Good. Then I told you, get the net, assuming those are the only ones. Get the net, push whatever you are getting to the extreme. Push whatever you are getting to the extreme. That amount, let me for now assume that our negatives were more than the positive. So I want to put it in bracket because I want to assume that the negatives were more than the positive. So we call it net cash outflow from investing activities. Net cash outflow from investing activities. Good. That is the second category. We now go to the last category. That's what we call cash flow from financing activities. Cash flows from financing activities. Cash flows from financing activities. Good. So let's remind ourselves, we have just mentioned them. We have just mentioned what are the financing activities. I've given you an example like issue of shares. Whatever it is, I've given you issue of debentures. Whatever it is, I've given you loan repayment. Loan repayment, that is of course an outflow. You paid part of your loan. Then I've told you, you can now pay the financiers their return. Told you dividends paid is part of financing. That's an outflow. And I told you interest paid is part of financing. Then you get the net, push it to the extreme. Get the net, push it to the extreme. For now, I want to assume the net is a positive again. Push it to the extreme. I want to assume it's a positive. If it's a positive, we say it, you call it net cash inflow. Net cash inflow from financing activities. Net cash inflow from financing activities. Good. Finish. Once I'm through with the three categories, I told you do what next? I told you, you add the three totals. You add the three totals. That is the operating, the investing, and the financing amount. Add those three. Whatever you get, I told you if it's a positive, you call it increase in cash and cash equivalent. Increase in cash and cash equivalent. Then I told you, you now come and add opening cash and cash equivalent. Whatever you add, then you get whatever you get down there, and that is what I told you should be the same as the closing cash and cash equivalent. Closing cash and cash equivalent. Good. Finish. We now move on and discuss something else. We want to develop the topic slightly, but we are still reminding ourselves what you used to do before. I've not introduced any aspect of the group. No, not yet. But because even this information you still need, even at this level, you still need all this plus the aspects of the group. Before we go to the aspects of the group, I want to continue now. Okay, so finish. Okay. I hope you are through now. I hope you are through. Listen to this now. I told you that there are two methods of presenting a cash flow statement. This is the method I called the indirect method. This is the method I was calling indirect method. Listen. Then I told you there is another method called direct. This is indirect. There is another one called direct method. And I also told you the difference between the direct method and the indirect method. I told you the difference is only on how you present your operating activities. Your financing activities and your investing activities, I told you, they remain the same. They remain the same. So, now let me take you through again. How are you using or determining the cash flow? Don't write. How are you determining the cash flow from operating activities using the method we are calling the direct method? We just want to remind ourselves to get the cash flows from operating, don't write, from the operating activities. Listen to this now. This method was shorter. This method is normally shorter than the first one. Listen. For this method, to get the cash flow from operating activities, you normally need one figure there, another one there, another one there. You need those three. Once you get those three, get the totals, you less tax paid, which is the same like the other tax paid you paid, then you get the net. And you push it to the extreme. And whatever you are getting using this method and the other method in terms of cash flow from operating, the two methods will still give you the same amount. But the only issue is, now you need to remind me, what were these three figures? What were those three figures? For you to get the cash flows from operating activities using the direct method, there were three figures you needed. One of them is a positive. Two of them are negatives. At least I've reminded you, so that you need to tell me now, which ones were these? Somebody now tell me. Give me any one of the three figures that you remember. Give me any one of the three figures that you remember. Give me one of the three figures that you can remember that was cash flow from operating using direct method. Somebody you chat and tell me one of any of the three. Any of the three. Chat and tell me any of the three figures that you can remember. Direct method. I'm waiting. I'm waiting. Yes, thank you. That's one. Another one. That's one. That's true. Another one, somebody. Lillian, maybe you could also add another one. No problem. Lillian, you can also add another one if you have it. Joy, no. Joy, no. Payment to suppliers, that's correct. Payment to suppliers, that's Kiama, that's true. Discount, no, not discount payments, no. So we have identified two. Listen, we have identified two. One is cash received from customers. That's an inflow, of course. This is cash received from customers. That's one. The cash that your business received from your customers. That's one. The other one is the cash paid to suppliers. Somebody has already identified. Listen. When we say we are looking for cash received from customers. We are not saying cash received from debtors. Get the point there? When we say cash received from customers, we are not saying cash received from debtors. It's true, debtors are customers, but we are looking for cash that we received, listen, from all our customers. You could have sold goods to your customers on cash. You could have sold goods to your customers on credit. And then they later paid you. So from all our customers, whether they were cash customers or they were credit customers, how much did we receive from them? That's why we are calling it cash received from customers, not cash received from debtors. No. Two, we are saying cash paid to suppliers. We are not saying cash paid to creditors. Listen, we are not saying cash paid to creditors. No. We are saying cash paid to suppliers. Meaning, to all your suppliers. These are people you purchase goods from. From some of them, you could have purchased goods on credit, then you later paid them. From some of your suppliers, you bought goods on cash basis. So from all your suppliers, what is it that you paid to them? Whether they are cash suppliers or credit suppliers, in total, you want to know what is it that you paid. Good. Somebody has given me another one. Payment to operating expenses and tax paid. Tax is down here. That one we have already identified. Now, it's true, it has something to relate to it. Now we say the third one is what we call cash paid for services. We normally call it cash paid for services rendered. We normally call it cash paid for services rendered. Listen, as a business, different people give you services. What is it that you paid for those services? Employees gave you service. You must have paid them salaries. Kenya Power gave you lighting. You must have paid them for electricity. And all the stakeholders that helped you to run your business. Workers, you paid them salaries. Kenya Power, you paid them electricity. Insurance, you paid them for insurance services and so on. In other words, these are expenses. The services people give you are costs incurred in the running of the business. Those are expenses. What is it that you paid for all the expenses of your business? Get the amount you paid in total for all of them. Listen carefully. The only issue when it comes to this method, which we are calling direct method, none of these three figures, none of them is given. All of them, you must calculate them. How much is the cash received from customers? That is something you have to calculate. How much you paid to suppliers, that is something you have to calculate. How much you paid for services rendered, that's also another thing that you have to calculate. So for all these figures, that is the only issue, that you must calculate them. Yes, the method is short because you only need 3 figures. It's not like the other method where there was a long list of the operating. Here you only need 3. But the only problem is that you must calculate. So anything going wrong in your calculation, you miss a figure here, or you add wrongly in your calculations, that figure is gone. Next one, somebody went somewhere wrong, you picked the wrong amount. One thing, because to get the cash received from customers, there are several things you add and minus, whatever we shall see. But if you took a wrong figure and the others were right, then the amount will be wrong. For suppliers, we want to know how much we paid to our suppliers. There are many things that come up with it and how to get it. If one of them is wrong, then even the amount paid to suppliers is wrong. The other figures could be right. That's the only consequences about this. Okay? Now, for now, I would wish to stop there. Next time, that is for my normal students now, I will discuss this now in detail. Today is Monday. Our next class is Wednesday. So on Wednesday, I'll first go through and discuss how to get the cash, these 3 items in details. Then once I discuss them, then we shall go back to the operating activities, to the cash flow, and there are some things that even the examiner sometimes doesn't give you among the other figures, whether investing or financing. I will discuss them. Once I finish the other items, that maybe the small tricks that the examiner would hide for identifying the other items, now after that, I'll now go to the aspects that affect group. The group aspects include how do you account for an associate in cash flow? How do you account for non-controlling interest in cash flow? How do you account for acquisition of a subsidiary during the year in the cash flow? Those are the aspects that normally affect group cash flow. Otherwise, for now, we have just been reminding ourselves how to prepare a cash flow for an individual company. The others about group, we shall only be adding to what we know. We shall only be adding to what you know. Good. So you will allow me to stop there for today. Then on Wednesday, I pick it up from there now. I pick it up from there. Now, listen. Before we leave, I know there are some new students in the group who are there for today's class. So, listen. I want to mention 1 or 2 other things concerning you as a new student. Some of you may wish to continue with us and join the normal class. If you wish to join the normal class for advanced financial reporting, I'm talking to the new students now, we have either early morning classes or we have evening classes. Our early morning classes normally starts from 5:30 in the morning to 7 a.m. That is every Monday, Wednesday, and Friday. That is for early morning. For evening classes, we normally start from 8 p.m. to 10 p.m. every Monday, like today, Wednesday, and Saturday. Okay? Good. Now, listen. Our system is such a way that in case you miss a class, let's assume you choose evening, and on Saturday you have a function or you are working late. Does it mean you will miss that class? The answer is no. You can go back to the group where the link was posted and you can watch the video of the class that you missed at your own free time. Or maybe I've taught you and you feel you want to listen to the class again, maybe there is something that passed you and you want to remind yourself, go back to the group, click on the link of the class you want to listen to, and you can listen to it as many times as you want. So those are the timings of advanced financial reporting, either early morning or evening. Some of you might say they are not available in the early morning, they are not available in the evening. We also have what we call pre-recorded videos. You can buy pre-recorded videos for the whole syllabus so that you listen to them at your own free time, at your own pace. So that's what you can also do. You can buy what we call the pre-recorded videos. Okay? Whether early morning or evening or pre-recorded videos, we are charging 4,000 shillings. And at the same time, you need to know that we also accept payments on installment basis. If you join today, either early morning or evening, I will also give you the videos of the classes that you have missed up to now. I'll give you the videos of all the previous classes. You will get all the videos of the previous classes. That should not make you get worried whether you have already missed those classes. No, you will get the videos of those classes. Okay, good. So if you are interested in either, then you can call me on this number 0722 0722 6588 0722 658875. That is the number you can call me with. You will get me 0722 658875. Good. Now, still on that, I'm talking to the new students and everyone now. You may have some of your friends who are doing financial reporting of the intermediate level, or what we used to call Section 3. For them also, we have classes for them. Again, it is from 8 p.m. to 10 p.m. every Tuesday, Thursday, and Friday for the financial reporting of the intermediate. Same thing again, in case you miss a class, you can still watch the video of the class that you have missed by going back to the group. Again, the charges are 4,000. Tell them, those who are interested in joining, that they can call me on this number. Good. Listen, we also have financial accounting of the foundation level, or what we used to call Section 1. Financial accounting. That financial accounting is also part of the ATD 1 financial accounting and ATD 2. There is also a financial accounting there. So it's either financial accounting of CPA, foundation level, or Section 1, or financial accounting of ATD 1 and financial accounting of ATD 2. Okay? Before we leave now, I think I've mentioned everything. Before we leave, again, I would ask you, if you have not subscribed to my YouTube channel, please subscribe. Click that subscription button down there and subscribe, so that in case we post new videos in our YouTube channel, you will be notified. Those are videos for free. You will be notified. But subscribe by clicking. Of course, our YouTube channel is called CPA Joseph Njuguna. That's the name of the YouTube channel, CPA Joseph Njuguna. Good. So I will ask you to subscribe to our YouTube channel. So click that subscription button. If you have not even done now, you can do it right now. You click it so that you subscribe to our YouTube channel. I think I've mentioned everything that you need to know, especially for the new students, What are the timings for early morning? What are the timings for the evening? In case you miss a class, can you still get the class? Yes. Are you going to get the videos of the previous classes? Yes. How much are you charging? 4,000. Do you accept payments in installment? Yes. If I'm not available in the early morning, I'm not available in the evening, can I get the pre-recorded videos? Yes. Good. Then our number there is 0722 658875. Then for financial reporting, again 8 p.m. every Tuesday, Thursday, and Friday. The modalities still apply. They will get the videos of the previous class and they can watch the videos of their own at their own free time. So for those who have friends doing financial accounting, tell them also we are offering financial. Finally, please subscribe to my YouTube channel by clicking that subscription button down there. Otherwise, good night. Unless there is somebody who has a comment, we can stop there for now. Maybe a new student who has joined us today and he has a burning comment, he can write that comment on this live chat. Somebody who has a comment, maybe a student who is new and he wants to ask a question, you can chat. Or if you can't chat, you can call me after this. You can call after this. Okay. So allow me to stop there for now. Allow me to stop there for now. We pick it up from there. When are we starting block release? Block release, we always start at the end of the year, at the end of the semester, sorry. Now, listen. For some of you, by the way, you may also know or you may have done this subject before, but you don't want to join the normal class, but you also want to have revision. There is something we normally call special revision. That is not the same as block release. No. Special revision normally starts early, so it covers more than block release. So if you wish to join a special revision, then you can still call me again. So maybe you feel you have done the subject before and you don't want to join the normal class, but you want revision. So we normally have what we call special revision, which normally starts early. But for block release, we normally start it 1 month before the exam. 1 month before the exam. But for special, we normally start it almost immediately after the results are out. So you can call me if you are interested in the special revision class. Okay? Good. So for Catherine, maybe if you have done this subject before, you may need then special revision class. Okay? So that you review what you know or you revise what you know. Okay? Okay, Catherine, I hope you have understood. So let me close the class, and unless there is another comment, let me close the class. Otherwise, good night for now. Good night for now. Thank you, Catherine. Okay, good night. Good night.